Disclaimer.
Lock in for the next few minutes because what I'm about to share with you is not speculation, it's not theory, and it's definitely not another market commentary piece you can scroll past. This is about the financial plumbing that keeps our entire economy running, and right now, that plumbing is showing cracks that Wall Street doesn't want you to see. Here's what I need you to understand. There's a $12.6 trillion market operating in the shadows of our financial system. Every single night, while we sleep, this market moves more money than most countries produce in an entire year. Banks, hedge funds, the biggest financial institutions on the planet, they all depend on it to survive. And most Americans have never even heard its name, the repo market. Now, if you're like most people, you probably think repo has something to do with someone taking your car. But what's happening in this market right now is far more consequential than any vehicle repossession. Because when the repo market seizes up, when the cost of overnight cash suddenly spikes, it means major financial institutions are desperate for liquidity. And desperate institutions make mistakes that ripple through the entire economy. Think about it this way. The repo market is like the electrical grid that powers your home. You flip the switch, the lights come on, and you never think about the massive infrastructure humming in the background. But when that grid fails, everything stops. Your refrigerator, your heating, your ability to function. That's what the repo market is to our financial system. And right now, that grid is flickering. Just last week, on February 4th, 2026, the Financial Stability Board issued a stark warning. This is the global watchdog that coordinates regulatory policy among the world's 20 largest economies. They said vulnerabilities are building across the $16 trillion government bond-backed repo market, highlighting rising leverage among hedge funds and growing dependence on short-term funding. When the people whose literal job is to monitor global financial stability start using words like vulnerabilities and building, we need to pay very close attention. But this warning didn't come out of nowhere. Let me show you what's been happening behind the scenes. Back in mid-September 2025, the Federal Reserve's standing repo facility, which is essentially an emergency backstop for banks that can't get funding anywhere else, was tapped for roughly $18.5 billion in a single day. Now, the Fed created this facility specifically for moments of stress. It's the financial equivalent of a fire extinguisher behind glass. Break in case of emergency. And on that September day, banks broke the glass for the largest single-day draw since the facility was even created. Here's where it gets really interesting. This wasn't some isolated incident. By the end of October, the Fed executed a $29.4 billion overnight repo operation, the largest single-day liquidity injection since the early 2000s dot-com era. Bank reserves had plummeted to $2.8 trillion, their lowest level in over 4 years. The financial system that keeps our entire economy functioning was clearly under pressure. And then came the year-end scramble. On December 31st, 2025, the standing repo facility spiked to $75 billion as banks desperately adjusted their balance sheets. The Fed will tell you this is normal year-end activity. Window dressing, they call it. But when you step back and look at the pattern, a very different picture emerges. So what exactly is happening? Why are banks rushing to the Fed's emergency window like it's the last lifeboat on a sinking ship? Let me break this down in a way that actually makes sense. Imagine you run a business, and every single day you need to borrow money just to open your doors. You borrow tonight, you pay it back tomorrow morning, and then you borrow again. That's essentially how major banks operate. They use short-term funding from the repo market to finance their operations, their trades, and their obligations. The collateral they put up? Usually Treasury securities, the bonds our government issues to fund itself. When everything runs smoothly, the system is incredibly efficient. Banks get the cash they need at predictable rates, lenders earn a small return on their money overnight, and the wheels of finance keep turning. But when stress enters the system, when banks suddenly need more cash than the market can easily provide, repo rates spike. And when rates spike, it means one of two things. Either there's not enough cash to go around, or lenders don't trust the borrowers as much as they used to. We've seen this movie before. In September 2019, repo rates suddenly spiked from around 2% to 10% in a single day. The Fed had to intervene with hundreds of billions in emergency liquidity. That was supposed to be a wake-up call. And yet here we are, watching the same warning lights flash again. But this time, there's something different lurking beneath the surface. Something that connects these repo market tremors to a much bigger problem sitting on bank balance sheets across America. Think about your own finances for a moment. If you bought a house with a low fixed-rate mortgage back in 2020 or 2021, you locked in those rates. You're sitting pretty. But what if you were a bank that loaded up on long-term Treasury bonds yielding 2%, and now those same bonds are trading in a market where new bonds yield 5%? The value of your holdings just cratered. On paper, you're underwater. And if you need to sell those bonds to raise cash, those paper losses become very real, very fast. This is exactly the situation facing banks across our country right now. The FDIC reports that unrealized losses still stand at $337 billion as of the third quarter of 2025. And here's the kicker. Any rise in long-term interest rates could push those losses right back up almost overnight. The problem hasn't been solved. It's been hidden. Want proof that this isn't just theory? On January 31st, 2026, Illinois regulators quietly shut down Metropolitan Capital Bank, a small institution with just $261 million in assets. Nothing that would make the evening news, right? But that same Friday, gold and silver experienced one of their sharpest single-day plunges in decades as investors scrambled for liquidity. The first bank failure of 2026 landed right in the middle of a violent global sell-off. Coincidence? The smart money doesn't think so. The repo market stress we're witnessing isn't just about overnight lending rates. It's a symptom of something deeper. A financial system that's been running on borrowed time and borrowed money, with balance sheets stuffed full of assets that aren't worth what they used to be. And the most concerning part? The institutional traders, the hedge fund managers, the bank executives, they're already repositioning. They're reading the same data I just shared with you. The question for us, as everyday Americans trying to protect what we've worked so hard to build, is whether we're going to pay attention to the same signals they're watching. Because what's happening right now in the repo market, what the Financial Stability Board just warned us about, and what those unrealized losses mean for the banking system, these aren't isolated events. They're connected pieces of a larger picture that's coming into sharper focus every single day. And in the next section, I'm going to show you exactly how deep this rabbit hole goes, and what the historical record tells us about what comes next. Now here's where we need to dig deeper, because what I'm about to show you connects directly to two of the most devastating financial collapses in modern history. And the patterns are almost identical to what we're seeing today. Let's start with a name most people have completely forgotten. Creditinstalt. In May of 1931, this Austrian bank, the largest in the country, suddenly collapsed. Now here's what makes this story so important for us today. Creditinstalt didn't fail because its assets were worthless. It didn't fail because management made terrible investment decisions. It failed for one simple reason. It couldn't convert its assets into cash fast enough to meet its obligations when depositors and creditors came calling. A liquidity crisis, pure and simple. The assets were there on the balance sheet. The value existed on paper. But paper value means nothing when you need actual cash to keep the lights on. Now watch what happened next, because this is where it gets terrifying. That single bank failure in Austria triggered a cascade that spread across the entire Western world. German banks faced runs within weeks. British banks faced runs shortly after. The Bank of England was forced off the gold standard, and within months, over 2,000 banks in the United States had failed. 2,000 American banks gone. Not because of bad loans or fraud or incompetence, but because the overnight lending markets froze and banks stopped trusting each other. The common thread in every single one of those failures wasn't bad assets. It was liquidity. These institutions had value on their books. They had buildings, loans, securities, real economic assets. But they couldn't access cash when they needed it most. And when the interbank lending system froze, when institutions stopped extending credit to each other overnight, the entire financial system came crashing down like dominoes. Now fast forward to September 2008. Lehman Brothers. Most people remember Lehman as a bankruptcy caused by toxic mortgage-backed securities, and that's partially true. But here's what the textbooks and the documentaries almost always miss. The actual mechanism of death, the thing that pushed Lehman over the edge, was a repo market freeze. Not the mortgage losses, the repo market. In the summer of 2008, Lehman was still operating. The trading floors were active. The building was full of employees. The firm had assets on its books worth hundreds of billions of dollars. It had revenue coming in. By every visible measure, it was a functioning investment bank. But here's what most people didn't see. Lehman relied on the repo market to fund its daily operations, borrowing tens of billions of dollars every single night using its securities as collateral. Every morning, Lehman would pay back yesterday's loan and take out a new one. This worked perfectly fine for years, until it didn't. In early September 2008, something shifted. Repo lenders started getting nervous. First, they demanded higher haircuts, meaning they would lend less money against the same collateral. If Lehman posted $100 million in securities, lenders who used to give them $98 million would only give them $90 million. Then those same lenders demanded higher interest rates on top of the bigger haircuts. And finally, in the days before the collapse, they stopped lending to Lehman altogether. The repo window slammed shut. On September 15, 2008, Lehman Brothers filed for bankruptcy. Not because its assets had suddenly become worthless overnight. The buildings were still there. The securities still existed. But none of that mattered because Lehman couldn't access the cash it needed to open for business that Monday morning. The repo market had frozen solid, and the firm that had survived for 158 years was dead in a matter of days. Here's the part that should send chills down your spine. Once Lehman fell, the contagion spread like wildfire through the entire system. Money market funds broke the buck, something that was never supposed to happen. Commercial paper markets seized completely. Credit default swap spreads exploded. The entire global financial system came within hours of a complete shutdown. The Treasury and the Fed had to inject trillions of dollars through TARP, through the discount window, through emergency facilities, just to keep the lights on across Wall Street. Now here's what I need you to understand about our current situation. The same structural vulnerabilities that killed Credit Instalt in 1931 and Lehman Brothers in 2008 are present in our financial system today. Different names, different decades, different specific circumstances, but the same deadly pattern of illiquidity masquerading as normalcy until it suddenly isn't. Let me show you the proof with current numbers. According to the FDIC's most recent quarterly banking data, unrealized losses on securities held by American banks stood at $337 billion as of September 2025. Now, that number has actually improved from its peak of over $680 billion in late 2023. The Fed will point to this as progress, recovery, nothing to worry about. But here's what they won't tell you in the press releases. Those losses improved primarily because long-term interest rates declined slightly during that period. The 10-year Treasury yield came down, mortgage rates eased a bit, and the market value of those underwater bonds ticked up. Great news, right? Except here's the problem. The moment rates tick back up, and they've been incredibly volatile, those unrealized losses balloon right back to crisis levels. We're not talking about losses that have been resolved. We're not talking about banks that sold their underwater positions and moved on. We're talking about losses that are hiding in plain sight, waiting for the wrong market conditions to resurface. The Office of Financial Research puts this in even starker terms. They report that banks' unrealized losses represent approximately 8.6% of the fair value of their total securities holdings and nearly 20% of their aggregate equity. Let that sink in. 20% of the banking system's equity is sitting in unrealized losses. That's not a rounding error. That's not a minor accounting footnote. That's a structural vulnerability embedded in balance sheets across America. And here's the critical connection to the repo market stress we discussed earlier. When a bank holds Treasury securities with unrealized losses and suddenly needs cash, it has exactly two options. Option one, sell those securities on the open market and crystallize the loss. Take the hit, watch your capital ratios deteriorate, potentially face regulatory action. Option two, borrow against those securities in the repo market, pledge them as collateral, and get the cash you need without actually selling. But what happens if repo lenders see stress building in the system? What happens if they start demanding higher rates, bigger haircuts, or refusing to lend altogether? That second option disappears, and suddenly, option one becomes the only path forward. Forced selling into a falling market. Losses that compound on losses. The death spiral that killed Credit Instalt, that killed Lehman, that killed Silicon Valley Bank. Speaking of Silicon Valley Bank, let's talk about March 2023 because it's the most recent example of this exact pattern playing out. SVB held long-term bonds that had cratered in value as rates rose. For months, those losses sat on the balance sheet as unrealized. No problem, right? Just hold to maturity. Except then depositors started withdrawing funds. The bank needed cash. They tried to sell their bond portfolio, and the losses, which had been theoretical numbers in a footnote, became devastatingly real. The bank collapsed in less than 48 hours. 48 hours from functioning institution to FDIC receivership. Now multiply that scenario across the entire banking system. That's what the repo market is telling us might be coming. But wait, there's another layer to this story that makes it even more concerning. Because the repo market stress isn't just about banks, it's about who else is playing in this space with enormous leverage. The Financial Stability Board's February warning specifically highlighted rising leverage among hedge funds. And according to the Bank of England, leveraged activity by hedge funds and government bond repo markets reached record highs in late 2025, dominated by a small number of mostly US-managed funds reliant on very regular refinancing. Read that again carefully. A small number of highly leveraged hedge funds, concentrated positions, dependent on being able to refinance those positions every single day. What happens if that refinancing suddenly becomes expensive or unavailable? The Bank of England spelled it out in plain English. If that financing suddenly dried up, hedge funds might have to dump government bonds in a fire sale, and fire sales create cascades. Prices drop, which triggers margin calls, which forces more sales, which creates more unrealized losses at banks, which creates more repo market stress, which forces more sales. This is how liquidity crises transform into solvency crises. This is how Credit Instalt became 2,000 American bank failures. This is how Lehman became a global financial meltdown. Here's the pattern recognition that should concern every American with money in the financial system. In 2019, repo rates spiked unexpectedly and the Fed intervened with hundreds of billions. Crisis contained. In March 2020, COVID hit, and the Fed injected over $1 trillion in a matter of days to prevent the repo market from freezing. Crisis contained. In March 2023, Silicon Valley Bank collapsed. Regional banks couldn't access funding, and the Fed created an entirely new emergency facility. Crisis contained. Each time, the Fed stepped in. Each time, disaster was averted. But each time, the underlying vulnerabilities remained in place, waiting for the next stress event. And now, in late 2025 and into 2026, we're watching those same warning signals flash red again. Record usage of the standing repo facility. Bank reserves at 4-year lows. A global financial watchdog issuing public warnings about systemic vulnerabilities. The first bank failure of the year happening alongside the sharpest precious metal sell-off in decades. The Federal Reserve has been trying to walk an impossible tightrope. They raised interest rates aggressively to fight inflation, which caused bond values to drop, which created those unrealized losses on bank balance sheets. At the same time, they've been running quantitative tightening for years, pulling liquidity out of the system, which is exactly why bank reserves have dropped to levels not seen since 2020. They're simultaneously creating the conditions for stress while removing the cushion that traditionally absorbs that stress. Something has to give. And in December 2025, the Fed quietly took a step that tells you everything about what they're preparing for. They eliminated the $500 billion daily limit on standing repo facility operations. The cap that had been in place since the facility was created, gone. Ask yourself a simple question. Why would the Fed remove the ceiling on emergency lending unless they anticipated potentially needing to lend more than $500 billion in a single day? The institutions that understand this dynamic, the ones with Bloomberg terminals and risk management teams and direct lines to Fed officials, they're not waiting around to see how this plays out. They're positioning their portfolios right now for what's coming. And in the final section, I'm going to show you exactly what the smart money is doing, the 3 specific strategies they're implementing, and how you can apply those same principles to protect and potentially grow your wealth in the environment that's unfolding right in front of us. So we've covered the warning signs, we've looked at the historical parallels. Now let's talk about what actually matters for you and your money, because understanding the problem is only half the equation. The other half is knowing what to do about it. Here's what the smart money has been doing while most Americans weren't paying attention. And I'm not talking about speculation or guesswork. I'm talking about observable moves backed by trillions of dollars in capital flows. Let's start with the most obvious signal. Gold just hit an all-time high of over $5,500 per ounce in late January 2026. Think about that for a moment. In the span of just over a year, gold has nearly doubled in value. This isn't some fringe asset that a few preppers are hoarding in their basements. This is a global monetary metal seeing institutional demand at levels we haven't witnessed in decades. And it's not just momentum traders chasing price. According to JP Morgan's research division, central banks and institutional investors are projected to demand around 585 tons of gold per quarter throughout 2026. That's central banks, the institutions that actually print money, choosing to hold gold instead of their own currencies. When the people who create dollars, euros, and yen are actively converting those currencies into physical metal, that tells you something profound about where they see this heading. JP Morgan is forecasting gold to average over $5,000 per ounce by the fourth quarter of 2026, potentially reaching $6,300 by year end. And they're not alone. Multiple major banks have issued similar projections, with some analysts seeing a path towards $6,000 or higher. But here's what matters more than any price target. The reasons driving this move are exactly the same reasons we've been discussing. Financial system stress, unrealized losses, repo market instability, and a Federal Reserve trapped between fighting inflation and preventing a banking crisis. Now let's talk about silver, because what's happening in the silver market might be even more significant for those paying attention. Silver surged 146% in 2025 alone, 146% in a single year, and it's already up over 55% so far in 2026, recently touching $117 per ounce. Bank of America has a price target of $170. Citi upgraded their forecast to $150. These aren't fringe analysts. These are the same institutions that trade billions in precious metals every single day. But here's what makes silver particularly interesting right now. Unlike gold, silver has massive industrial demand. Solar panels, electronics, medical devices, electric vehicles, they all require silver. And according to industry data, we're now in the 5th consecutive year of global silver supply deficit. The world is consuming more silver than it's producing, and that structural imbalance isn't going away anytime soon. You've got investment demand surging because of financial system fears, industrial demand surging because of the green energy transition, and supply that simply cannot keep up. Now, I want to be clear about something important. I'm not telling you to go all in on precious metals tomorrow. What I am telling you is that the institutional money, the smart money, the central banks themselves have been aggressively repositioning into these assets. And they're doing it for the same reasons we've been discussing throughout this video. Here's a quote that should grab your attention. Some major banks are now suggesting new asset allocation models that replace part of the traditional treasury or fixed income allocation with up to 20% in physical gold. 20%. We haven't seen recommendations like that from mainstream financial institutions in decades. When the same banks that typically push stocks and bonds are telling clients to hold a fifth of their portfolio in physical metal, the message couldn't be clearer. So, what does this mean practically for someone watching this video? Let me give you the framework the institutional players are using, broken down into 3 asymmetric positions. Position 1 is the defensive foundation, cash and cash equivalents in the safest possible vehicles. We're talking treasury bills with maturities under 90 days, money market funds that invest only in government securities, FDIC insured accounts well below the $250,000 insurance limit. This isn't about earning yield. This is about having dry powder when opportunities emerge. Here's why this matters in a liquidity crisis. When everyone is scrambling for cash, when institutions are being forced to liquidate positions at any price, the people holding actual liquidity can buy quality assets at pennies on the dollar. This is exactly how fortunes were made in late 2008 and early 2009. Not by those who tried to catch falling knives, but by those who held cash through the worst of it and then deployed that cash when the blood was in the streets. The key is avoiding duration risk. Do not be in long-term bonds or bond funds right now. If yields continue rising, those positions will get crushed further. Stay short, stay liquid, stay ready. Position 2 is the zero counterparty hedge. Physical gold and silver held outside the traditional financial system. Not ETFs, not futures contracts, not unallocated accounts at a bank. Physical metal that you either hold directly or that sits in fully allocated segregated storage with your name on specific bars. Why does physical possession matter? Because in a liquidity crisis, the weakest link is always counterparty risk. Your bank deposit is a liability on the bank's balance sheet. If that bank has problems, your deposit has problems. Your brokerage account holds securities through a custodian. If that custodian has problems, your access to those securities has problems. Every paper claim in the financial system involves trusting some institution to honor that claim. Physical precious metals have zero counterparty risk. When you hold gold or silver in your possession, you own final settlement. There's no intermediary that can freeze your access. There's no institution that needs to remain solvent for your asset to have value. In a world where the repo market is seizing up and banks are rushing to emergency Fed windows, that independence from the financial system isn't just nice to have. It might be essential. Position 3 is for those with higher risk tolerance and longer time horizons. Distressed financial sector opportunities. When liquidity crises hit, bank stocks and financial sector equities get destroyed indiscriminately. Strong institutions sell off alongside weak ones. Companies with fortress balance sheets trade at valuations that assume bankruptcy. This is the exact playbook that made Warren Buffett billions during the 2008 crisis when he bought Goldman Sachs, and Bank of America preferred shares at prices that looked insane at the time. Within a few years, those positions had generated returns most investors never see in a lifetime. The asymmetry is that you're buying high-quality institutions at prices that assume the worst, but the reality is the best of them will survive and thrive once the storm passes. The key here is patience and discipline. Don't try to catch falling knives. Wait for the panic. Wait for repo rates to spike even higher. Wait for forced liquidations and emergency Fed interventions. Then, and only then, deploy capital into the highest quality names at the lowest prices. If you're not comfortable with that kind of volatility, stick with positions 1 and 2. There's no shame in playing defense. Now, here's what you need to be watching as this situation evolves in real time. The Federal Reserve Bank of New York publishes repo operations data with a 48-hour delay. If you see standing repo facility usage continuing to climb, if you see more than a dozen institutions accessing that facility regularly, stress is not subsiding, it's intensifying. Watch the SOFR spread. That's the secured overnight financing rate compared to the Fed's target rate. If that spread keeps widening, the private repo market is under sustained pressure. Watch Treasury bill yields at the very short end, specifically the 1-month and 3-month maturities. If those yields spike relative to longer maturities, institutions are desperate for short-term cash. And watch credit default swap spreads on major banks. If those spreads start widening significantly, the market is pricing in higher default risk, which will make everything we've discussed considerably worse. Here's the question I want to leave you with. Do you believe the Federal Reserve will step in early with overwhelming force to prevent a systemic crisis? Or do you think they've learned from past interventions and might let some institutions fail this time to restore credibility and finally break inflation? The answer to that question determines which scenario unfolds and how quickly. But either way, the preparation is the same. The repo market is the heartbeat of our financial system. And that heartbeat has been irregular for months now. The emergency facilities are being accessed at levels we haven't seen since the last crisis. Unrealized losses are sitting on bank balance sheets like unexploded ordnance. And the smart money is quietly repositioning into cash, into precious metals, and into patience. This isn't about predicting exactly when something breaks. It's about recognizing that the conditions for a break are present and positioning accordingly. The people who preserved and grew their wealth through 1931, through 2008, through March 2020, they weren't psychics. They were pattern recognizers. They saw stress building in the system, they positioned defensively, and when opportunities emerged from the chaos, they had the liquidity and the conviction to act. You now have access to the same information the institutions are watching, the same patterns, the same warning signals. What you do with that information is up to you. Stay informed, stay prepared, and I'll see you in the next one.